Hello everyone, welcome back to the chat room. My name is Ed Ponzi, your host for today. Today we are speaking, it's Monday, July 21st, and I don't see any questions from you guys, so if you forgot to get your questions in, please send them in. We are recording a little bit earlier than normal today. I guess that's a possible cause for it. There's a lot to talk about. And so I wanted to get on here right away and get it out to you. First of all, the New Zealand dollar, right? Wednesday is a very big day, so this will be the last time I speak to you before Wednesday. I assume that we're going to record next on Thursday. So for Wednesday, it's going to be a big day because, it's a big day for New Zealand. Because why? Well, that's the day that the Reserve Bank of New Zealand makes their rate decision. Now, let me tell you first of all, what makes the Reserve Bank of New Zealand different from other central banks? Well, New Zealand's kind of a smaller country, a smaller economy. And maybe the most interesting point about New Zealand is that the central bank does not have a decision-making body like the FOMC, for example. It's a 9-person body as part of the Fed that makes decisions on interest rates. It does not have a body like the Monetary Policy Committee, the MPC. That's a 9-person body that makes decisions on interest rates and other things in the UK. In New Zealand, it's basically down to one guy, right? The head of the central bank makes the call. Raise the rate, don't raise the rate. It's really kind of different and a little bit interesting because I guess the reason why it's interesting is because, when you have 9 people trying to hash out a decision like you do in the US or the UK, it's you can see the dissent forming, and we check the minutes and we know the votes in the UK. We said, okay, 6 people want this, but 3 people want that. You don't have that in New Zealand, and it's a little bit more mysterious, right? Because the process is basically happening in one person's head, and so everyone tries to get inside this one person's head to figure out what he's thinking. And the thought is that we are going to see a rate increase from the Reserve Bank of New Zealand to 3.5%. and that there will be further increases, possibly up to 4% as the year goes on. That was the way of thinking, but things can change. Things can change. And to demonstrate that, I want to show you the chart. You can see New Zealand. We showed you this chart numerous times. This 88, we hit some massive resistance, some very old resistance, but it worked quite well. And the Kiwi came down, Kiwi being the nickname for the New Zealand dollar, US dollar currency pair. What is going on here? What really hurt Kiwi is the price of dairy milk. And like people say, well, how can that be? That just sounds ridiculous. Because obviously, right, countries like Canada, we worry about, the price of oil and to a lesser extent the price of gold. Countries like Australia, we worry about the price of gold, the price of iron ore. But New Zealand, 30% of New Zealand's exports consist of powdered dairy milk, which is a topic we've touched on before. But what's changed is that the price keeps falling. And it's just, and this is probably why I've had a hard time getting my head around this currency recently, but I think it's all clearing up now. The dairy prices have been falling, and the latest one we saw a drop of 8.9%. How is that possible with all this demand? New Zealand's this tiny country, and China's gigantic and right next door, and China needs this product because China's very polluted. So let's just say like there's a tremendous amount of pollution in the sky, and it rains. And now your cow is going to lick that pollution up. Either it's on the grass, it's in the puddles, and your cattle are going to consume that. And now you've got, beef that's maybe not as high quality and milk that's not as high quality as you would like. Meanwhile, so the demand for stuff from New Zealand should be growing, right? Because meanwhile, New Zealand's right next door. They've got all that stuff. Well, what happened? What changed? Why is the price dropping? Well, price is it's a result of supply and demand. Demand should be rising, we say, or we believe, but demand is falling. Demand for New Zealand's dairy products are falling. Why? Why is that? How is that even possible? I mean, as China becomes a wealthier nation, you would expect more and more people to develop a taste for the better things in life, like, I don't know, uncontaminated food maybe? Okay, so New Zealand dollar, though, getting pounded because they're stockpiling it. In China, they've stockpiled a tremendous amount of powdered milk. It's exactly the same sort of thing that happened with Australia and iron ore. The complaint about iron ore was that so much of it piled up at the ports in China that, you know, they didn't need any more and the price began to drop. Well, think of dairy milk in the same way. That powdered milk, you can stockpile it. I guess it, you know, it doesn't spoil. And apparently China's sitting on a bunch of it now. And they're not ordering new. They're not reordering. They're not re-upping. And this is hurting New Zealand, but why? Because this is 30% of their economy, man. I mean, it's a farm, right? If you think of, I like to think of simplistically here, right? I think of, for example, Australia is a big mine, one place as opposed to the other. And now there's an erroneous thing going around where people say, all right, if New Zealand has an interest rate of 3.5 and the U.S. is an interest rate of 0, then you get the difference. You get 3.5, and that's not correct. You're not guaranteed 3.5 by any means. The broker is going to take some of that because there's a spread on rollover payments just as there is a spread on a currency pair. But, you know, keep in mind, right, it's basically free money. And the beautiful thing about a carry trade is that it becomes self-fulfilling. Think about the pleasure principle, right? Suppose, like, if I press button number A, I get a piece of candy, and if I press if I press button A, I get a piece of candy. If I press button 2, I get an electric shock, a mild electric shock. Which are you going to take? You're going to take the piece of candy, right? And that's the same theory, by the way, behind pound yen. British pound, like the UK is going to start raising rates sometime soon. Japan is never going to raise rates within the foreseeable future. And so the interest rate differential between the UK and Japan is going to grow. And it's going to be like being long, the pound against the yen is like every time I push that button, I get a little piece of candy. And every time I push the short button, because if I'm short this, I have to pay the interest, right? If I press that button, it's like getting a little electric shock. Now, as the differential grows, the reward and the shock get bigger, right? So, you know, if interest rates in the UK begin to rise, now when I press button A, I get a rotisserie baked chicken instead of just a piece of candy. And now when I press button B, I get a pretty darn hot electric shock as opposed to that mild one I was getting earlier. Why? Because the reward becomes bigger and the punishment also becomes bigger as the differential widens between the two currencies. And New Zealand yen would be also potentially a very good potential currency carry trade. And what do you know? It's pulling back to support. So maybe that's the one that we should be focused on. I'm already long pound yen. That's the only reason I'm not in New Zealand yen. But maybe maybe somebody else out there is going to make some money on it. That's a pretty nice trend line, don't you think? Think that trend line goes back a long way? I do. I think it goes back to 2012. I think it's 2 years. You've just pulled back to support. Okay? So as the difference between the interest rate in New Zealand and Japan widens, which is what everybody expects, then nobody's going to want to push button B and get that electric shock. And that makes it easier for the price to go up. Nobody wants to short it because they know if they short it, they're going to have to pay. But more people are going to want to buy it because they know if they buy it, they are going to receive a little something. piece of candy, a rotisserie baked chicken. I'm getting hungry over here. Okay, so anyway, you get the point, right? So New Zealand yen may be the way to go here. I can't buy it because I'm long pound yen, but it's the same trade basically. The only thing is I would hold off until Wednesday, but maybe this is one you should keep your eye on, is New Zealand yen. Okay, all right. Let's see. We don't have any questions here this week, so be sure to keep sending your questions in, gang. I'm more than happy to answer them for you. Let's start talking about stocks a little bit for all my stock people out there. I want to introduce you to an interesting situation that I found. Chicago Bridge and Iron. Check out this chart first of all. You're looking at a stock that's just been smashed. Why was this stock smashed? It was smashed because an analyst came out and said their accounting, CBI's accounting, is irregular. And by the way, I posted it up on Twitter. I did buy CBI today, a half position. Why half? Because they report earnings on Thursday. So you get half now and you get half after the earnings is the way I'm looking at it. So here's CBI. So the stock gets crushed. I'll show you the volume too. Because a short-selling analyst comes out and says there's some kind of accounting irregularity. So the stock gets mashed from like 84 down to 65, just gets crushed. Right? So it loses 20%, all right, over a couple of weeks. Now the details begin to emerge. The company that came out with this analysis is short the stock. Now that in itself doesn't mean that they're wrong. We know, for example, we're all familiar with Bill Ackman and Herbalife, and Herbalife is getting killed as we speak because everyone knows that Ackman is about to drop the hammer again on Herbalife. He's going to give another presentation. I believe it's scheduled for Tuesday, but the presentation is clearly leaking out early. Ackman was on TV this morning, and Herbalife is getting smoked. All right, and that's a short seller who thinks he knows something about the company. This short seller says, yeah, I'm short, but I think this company's worth zero. I think it's a Madoff scheme. I was going to say Ponzi scheme, but obviously Madoff makes that Ponzi guy look like a piker, so it's a Madoff scheme, right? That's what he says. I don't know who's right. And he's short. He puts his money where his mouth is. Well, same kind of thing happens here, only they're not saying CBI, they're not saying that this is a Ponzi scheme or a Madoff scheme or whatever you want to call it. They're just saying there are accounting irregularities. Now, I'm very fortunate. I know a few people who are pretty good with this accounting stuff. And I asked, I don't want to drop any names, but I asked someone you've probably heard of, and he told me that a guy who really understands accounting thinks that, well, he believes that this company that's selling short and saying that CBI has accounting problems, he thinks they just misunderstood the accounting. He thinks they misunderstood. I don't want to go into all the gory details because we'll be here all day. But there was a key part that may have been just misunderstood. Okay, there's a key part there, and you know, according to the company, they're like, dude, we're using GAAP accounting, generally accepted accounting principles. So here's the stock that's mashed down, maybe on a complete misunderstanding. What do we know about it fundamentally? Fundamentally, it's extremely cheap. Fundamentally, I mean, it's trading at 11.5 times earnings. It's got a PE ratio of 11. You know who bought a bunch of this last year? Warren Buffett bought 6.5 million shares. You think Warren Buffett buys overvalued stocks? You think Warren Buffett doesn't do a lot of research before he buys a company? A lot of fundamental research? Warren Buffett owns it. Now that's not a pretty chart long term, but look at the damage that it suffered. And now I'm going to introduce you to another factor here that maybe is not quite understood. This is something I haven't done with you earlier, but you'll enjoy this. Let's pull up the options chain for CBI. That's Chicago, Bridge, and Iron. We bought some today, a half position. Now these are the July options. Obviously it's, July 21st. We're not worried about the July options. July is almost over. Talk about the August options. The August options expire on August 16th. I want you to look at the open interest on the calls, and I also want you to look at the open interest for the puts. So this column is open interest for the puts at various strike prices, and this column is open interest for the calls at various strike prices. Does anything stick out as being a little bit different? One of these things is not like the others type of thing for all you Sesame Street fans? Which one of these is not like the others? How about the August 16th, 2014 $70 calls? 25,046 open interest. There is not one strike price on puts or calls with even 4,000 open interest. This one has 25,000 open interest. So what we are saying is this is unusual options activity. There is heavy, heavy buying of the August 70 calls. Now, if you understand puts and calls, calls expire worthless. These 25,000, they're all going to expire worthless unless CBI rises above $70 before August 16th. That green line is $70. You can see how it keeps getting closer and closer. Now remember, earnings are on Thursday, so the company's being kind of quiet right now. But you have a tiny bit of resistance here at 72.50. That's really not much to be concerned about. And you have some resistance way back here from May at about 76, but really this could go to 84. Look at that, this height here. I mean, when they come down fast, they don't really have time to create resistance levels that are going to slow it down on the way back up. The resistance right now is 70. It's currently trading 68 and change. It breaks above 70. There's really just a little tiny bit of resistance here, and there's a little bit here, but there's really not much to stop it from getting back up to here. And those should be quick moves from the green to the blue, quick moves from the blue to the red, and quick move from the red up to 84. Unless there's something really wrong, and I can't guarantee you that there isn't something really wrong with this company, but I know this. Someone's placing a very big bet on this stock. 25,000 contracts. Somebody is betting heavily that this stock is soon going to be above 70, and the farther it is above 70, the more profitable those options become. So with earnings coming this Thursday, I've got to believe somebody either knows something or thinks they know something, and because these options expire in less than 4 weeks, that something is going to happen soon. And so could it be earnings? It could be, or maybe the company's just exonerated. I don't know. Maybe they're guilty of all this. I don't know. But it seems to me, you know, I'm doing my digging here. I'm doing my research. It seems to me that there's more upside than downside on CBI. Very low valuation. PEG ratio is less than 1. Warren Buffett owns 6.5 million shares. Couple of analyst upgrades. Recently. Okay, so all good things. All good things, I must say, about CBI. So I took a half position this morning. When we speak again next time, we'll talk about whether or not we're going to buy more or not. Okay, that We'll just have to wait and see what happens with the earnings. Now let's float around and look at some of our other positions. Now what happened was overall with the portfolio, and this is a portfolio, we sort of, when things got a little bit spooky in this market, when they began to look a little bit scared, we reined it in, we got rid of some of our positions, and we basically went, at one point we had almost as much short as we had long. And now we've been teasing it out toward the long side again. We've been adding more longs. But you'll notice that the type of companies that we're adding are a little bit different. In other words, we're still in half positions in Apple, which has done very well for us. We're up nearly 20% on Apple. And we're also in Amazon, which has done very well for us. We bought this at 310. It's at 358. That chart looks fantastic. We still have half positions in both, but you'll notice that's not the type of stock that we're buying anymore. Right? The stocks we've been buying lately have been, well, CBI, which we already mentioned, right? And ACT. ACT, we bought it at 215. Today it's at 216. This is a tax inversion play. You might notice Shire was taken over by AbbVie. AbbVie Pharmaceutical Company announced that they purchased Shire Pharmaceutical for $55 billion. Why? Because Shire is based in Ireland. They have a 13% tax rate. By making that move, by buying out Shire, AbbVie declares themselves an Irish company and lowers their tax rate to 13%. This is what happens when your tax rates are too high, by the way. Greedy, people want to raise taxes and they say, we're going to take this and we're going to take that from you. And the companies just say, screw that. We're just going to find a loophole. And Activist is another loophole, just waiting for someone to come along and buy it. All right? And if the U.S. wants to stop companies from doing this, what should they do? They should lower the tax rate so that it's not that different from Ireland's, and then nobody's going to want to leave. In fact, other companies might come here. What would that do for the economy? Man, I wish some people could add 2 and 2 together. We need some people in Washington who can add 2 and 2. Anyway, we're long CBI. We're long ACT up a tiny bit. We're long Wells Fargo. You notice the type of companies, though? And Wells Fargo is very, by the way, that's coming to rest on its 50-day moving average, I believe. Wells Fargo is a lot more of a conservative here. This is coming through just a little bit. I'm not worried about it. Pretty much right where we bought it. And Wells Fargo, CBI, these are cheap companies. They're not highly volatile companies. We've replaced a lot of our volatile longs with some less volatile stocks. ACT is a little bit more volatile, but it's not that bad. We still have DF, Dean Foods. Like I said, I'm not expecting anything to happen with this in the short term, but again, it's another company like Activist. It's a company that I expect to get taken out at some point because it's a small dairy company, and someone bigger should come along and buy it because that's the way they're growing their bottom line these days, is through acquisitions. We're still long some Starbucks too. SBUX. We're up like $2 on this. And we're long JCPenney. Sometimes I forget to mention JCPenney, but we're still long. We're just going to have to make that right shoulder a little bit wider. One of these days, JCPenney, one of these days. Maybe when earnings come out, right? And our shorts, wow, our shorts are doing well. Check out Lululemon. Boy, talk about a downward-facing dog. This is the yoga pants company. Just wants to go lower. Came up and kissed that. We shorted on the green line. Right? It dumps, it comes up, it fills the gap. We shorted on the green line, comes up, hits the 50-day moving average. Now the gap's really filled. It's done nothing but go south ever since. Good job there, Lulu. Who would have ever thought, that a company comes in, and you think about moats. What's a moat? A moat is what prevents another company from sort of taking over your business. And Lululemon had no moat. I mean, you're going to make these pants and sell them for $100. Well, nothing's more fickle than fashion. And it turns out other companies know how to make yoga pants too. So I don't really see how things are going to work out well for Lulu in the long run. I mean, they have no product exclusivity. And you're going to have Nike and other companies like that just biting at their tail. So I don't think it's going to work out for them. And we're short that one. We're short TJX. This has done nothing but continue downward. And I love this candle. You see this one here? Big red candle on high volume. Comes and engulfs a whole bunch of candles. Last week, I love to see that. Here we are again, getting close to new lows for TJ Maxx. I think this thing wants to jump off a cliff. All right, so anyway, so we've got those. That's a full review of our positions at this point. I don't think I missed anything. If I did, drop me a line, let me know. You know, like I said, New Zealand US dollar, looking for that for Wednesday. Euro pound, the 20 is still money. I know we have students who are just making bank on this one. It makes me so happy, right, to know that I have at least one student who's up like 240 pips on this. And why? Because he's trailing down that 20 moving average. Stop above the 20. It's trailing down. And every day that goes by, he's probably lowering that stop more and more, and that means his potential profit grows. Okay, gang, that's going to wrap it up. I just want to say thank you so much for listening. We'll be back on later this week. I think Thursday, but you never know. Maybe sooner. We'll be back later this week for more. So until then, everybody have a wonderful day. Be careful out there. My name is Ed Ponzi. Thank you so much for listening. We really appreciate your participation. Everybody take care.